Today's agenda, we are starting off with a macro briefing from myself instead of Ken. Then I'm going to look at a few different points in market-based valuation and some other considerations that you should be thinking about when analyzing a company. Then we're going to have an introduction to comparables and multiples from Ken. So without further ado, let's get started. So we saw initial jobless claims come out of the US this week at 1.5 million on a seasonally adjusted basis, which was well in line with consensus. And this means that the market continues to buy the V-shaped recovery narrative, where we're going to see a smooth economic reopening and the financial markets follow. Across the Atlantic, we saw some cracks in the EU's failure to pass 1.85 trillion euros of common debt past the frugal four, who are Netherlands, Denmark, Austria, and Sweden, which could be very bearish for the euro in the future and highlight some of the issues of trying to get things passed with 27 states involved. In the short term, they were able to step up and they passed 750 billion in euros, but in the longer term, it could be an issue. So debt mutualization brings with it financial stability and further integration, but it entails plenty of economic, financial, and moral hazard. Finally, a little bit close to home, and this kind of links back to the point we made earlier, is that we're going to start to see an economic reopening and what that looks like for the hospitality industry. So we could start to see the market check back on what's already priced in, with many UK pubs and bars expected to reopen at 40 to 60% capacity, which is going to be detrimental. And these kinds of hospitality businesses, pubs, retailers, and hotels have high cost to operate, meaning that they typically make their money on the last 20% of customers through the door. So when furlough schemes start to end and businesses have to decide whether they want to bring workers back, if it's not economically viable, we could see a second spike in unemployment. So I wanted to build on this point through the lens of central bank stimulus in the United States. And we saw that the Federal Reserve allocated $250 billion to start buying single corporate credits to complement their ETF buying program from earlier this year. And if they begin to target fallen angels, which are companies which have fallen in credit rating and have reached the investment grade border, it could be perceived as them trying to prevent these companies from being downgraded from investment grade to junk, which would affect many asset managers, especially pension funds, of which many elderly people's well-being are contingent on them paying out. So it could be seen as the Federal Reserve is trying to stop this issue. And in this regard, the Federal Reserve is still all in. So if you look at the corporate bond issuance chart, you would have never thought that there was a recession in 2020, looking at how easy it is to issue debt. And we just passed the total amount issued last year as well, year to date. So on the flip side of the central bank stimulus, it's been some time since the $1,200 stimulus checks have been issued, and they will have likely been spent by now. Additionally, the Federal Reserve are winding down dollar swaps, which are agreements to provide dollar liquidity to emerging market countries which need them, which could be seen as another withdrawal of liquidity from the global economy. So bringing all of this together, coupled with a potentially shaky reopening, where we see people potentially being laid off again and no longer being paid to stay at home, makes for a dangerous combination. One other interesting point is that Apple has been aggressively closing stores in the US, which is very likely it's a data-driven decision, which tells us a little bit about how they think this is going to play out. And when Apple closed stores, it's not just a spur of the moment decision. There's a lot of data that feeds into that. So to summarize this, I've taken a chart of the BBB corporate spreads, which have been flat since 6 June. So corporate spreads are the difference between an aggregate basket of investment grade bonds and a risk-free rate. Credit ratings tell us how safe a bond is to invest in relative to its credit risk. And the spread tells us the yield above a risk-free rate. So it kind of captures the risk of being invested in a corporate grade bond. So when spreads widen, it suggests that credit risk in this category is increasing. And so when spreads tighten, it naturally follows that credit risk is decreasing. And we've seen the equity markets have been pumping since 6 June quite significantly. However, the spreads haven't moved. And despite these new buying programs, this suggests that the bond market is telling us something different to the equity markets. And I should note that in the past, credit markets have had a better track record than equity markets in leading the overall direction. And we're going to come back to this from a single stock perspective a little bit later. So all of these points kind of make up the bear case for why we could see a correction and the markets fall again. But we want to cover both sides of the coin, and we want to think about the bull case as well. So Variant Perception are a independent researcher that provides asset research to multiple institutional investors. And from their count, we've seen multiple signs of bottoming. So consumer expectations have been rising. We've seen excess liquidity from the Fed, and there's still plenty of room for money to flow into risk-on markets, such as equities. And we can see this with the Bank of America Fund Manager Survey showing positioning still overweight bonds, and the State Street Investor Confidence Survey contracting, which is a relative measure of money being allocated towards cyclicals or defensives. And the reason why this could be the case is that the market has already rebounded a lot, and a lot of money managers would have missed this opportunity for being, some would say, too bearish, some would say cautious. And at this point in time, there's no real margin of safety, and investors are going to struggle to want to put money into the S&P when it's almost retraced to its pre-COVID levels. So investors may be looking for value in beaten down sectors that haven't recovered as much as others. And this could be something that you think about in your own sector when you're analyzing it. So have a look at the rebound relative to the overall market, and look at the opportunity relative to equities in general. So the second point on the bull case is MMT. And I'm going to start by talking about federal deficit, and then I'll come into formally defining what this is in a bit more detail. So the federal deficit is essentially a comparison between the money that is brought in tax receipts versus what we are spending. And deficit is the money spent that isn't taxed back. So if we have a deficit, it's the money, it's that money that we've spent and we haven't received in receipts. So modern monetary theory posits that the federal deficit doesn't actually matter, and that it's not the taxpayer that finances government expenditure, but rather it's the government. And it asserts that from the lens of personal household debt, this view of looking at debt where having too much is not a bad thing is not really applicable to a government entity that can print money. And MMT is dubbed as functional finance by many of its advocates, of which one of the leading researchers is Abba Lerner, who is one of Keynes's contemporaries. So this begs the question, does MMT really suggest that we can print unlimited money? And no, modern monetary theory argues that it's not these kind of preconceived constraints that we've imposed on ourselves by looking at a central bank or a government like we do a household, but rather the internal speed limit of the economy, if you will, which is regulated by our real productive resources. So kind of the potential GDP or potential output of the economy. So we're thinking of things like resources, technology, quantity and quality of land, etc. And if you do spend more, the downside or the downfall is that you're going to have inflation. So you're probably asking yourself, why does this matter to us as investors? And I've been thinking that if this theory starts to gain some traction because of the crisis, as we've seen, central banks have been printing money, significant amounts of money over this 1 or 2 months. If it actually works and we don't come away with some immediate issues or problems that will deter central bankers from continuing to do this, it could flip investment playbooks from the last few decades on their head. And this is definitely something we need to be thinking about. So now I want to start talking you through some other lenses you can use to analyze your company. So we've covered now the bull and the bear case for the overall market. So let's go back to some things which are applicable to your research. So we talked about valuing your business as a function of the money that it's going to generate in the future using discounted cash flows. And now we want to talk a bit about some of the other things that can help inform your decision making. So we have to remember that investment is always going to be two-dimensional. So it's not only what you think is going to happen, but also you have to understand all of the information that the market gives you, since at the end of the day, you are at the mercy of the market. So I want to start by giving a brief word about capital structure. So capital structure, by textbook definition, is the combination of debt and equity used to fund a business's operations. It's one of the most important aspects of finance in academia or courses, yet in practice, it's one of the most ignored things. From an investor's perspective, there are two ways to invest in a public company. So either you invest in its equity or you invest in its debt, which come with different characteristics. And these interests are often embedded in how each is priced, which offers us valuable information as investors. So when you hold an equity, you're entitled to the residual value of the firm. So if you go bankrupt, you have the last claim on the assets. Whereas if you're the debt holder, then you typically have a much more a claim that's much more prioritized. And there's a bit of nuance embedded within that, depending on the lien of debt you hold. But I'll put some links in the chat and you can have a read about that yourself. So this is important when a company issues equity or debt, you can get an idea of the management's thought process as well. Since if they issue equity or if they issue debt, they're either issuing a piece of the company or they're issuing an obligation to repay a stream of interest payments and a principal, i.e. the loan balance at some date and time. So if they're doing extremely well and they can handle the interest payments and they don't have a lot of existing debt already, then it may be better for management to issue equity. So you can think about that when you look at and read public offerings in terms of equity or debt from your company and try and glean what management is trying to do. And you'll often see the market react to these kinds of decisions accordingly. So we can also read investors' beliefs from looking at these different perspectives through comparing how an equity is trading to how their debt is trading. So for example, recently many retail traders have been piling into financial markets and buying up stocks such as Hertz on the edge of bankruptcy. However, many of these companies, although their equity went through the roof, their bonds didn't actually move, which displayed a conflicting view between the two. And this links back to the point I mentioned earlier, that the credit markets are typically smarter. So you're going to be seeing institutional investors putting their money behind these ideas. So if you do see an equity has pumped, it's always useful to check how their credit has been trading as well, and whether there's a consistency between the views. And for those who are interested, there's actually a hedge fund strategy that was spun out of this idea called capital structure arbitrage. And you can read a bit more about it if it interests you. So next, I want to talk about management. So at the end of the day, we're always investing in people, and the executives are going to be the ones who carry out your strategy. In some cases, people are quite literally the only asset that a business needs to succeed. For example, I could set up a boutique investment bank tomorrow, but short of charity, I can almost guarantee that I wouldn't land a single client. So it's important to understand how well equipped each person who's in a position of power is in terms of their ability to execute. So look at their track records, look at their industry experience, and compare it to what they say they want to achieve. So if there's an executive who has no experience in AI, who has a background in theater and arts, and he's talking about revolutionizing his business using blockchain technology, then you should be a bit skeptical. So in terms of incentives as well, we have to think about how our desires are aligned with the people we're trusting our money with. So the ways you can look at this are stock-based compensation. Think about, are they overpaid, and any other blaring conflicts of interest. So the way that stock-based compensation is going to work is that they're going to have a portion of their money, portion of their salary tied up in stock. So when the stock rises, their pay is a direct function of that. So generally, the higher the stock-based compensation for insiders, the better. Finally, I want to touch on ownership, which is important to the other dimension of investment that we talked about before, which is the pricing and the timing aspect. So institutional investors have to declare large company stakes every quarter, which gives us really information about who's long and who's short. So if we're going long, we might look at the short interest, which put simply is the amount of people who are short relative to the total stocks outstanding. And you can find that information online just by quick Google search. So we have to remember that there are so many people out there who is just as smart, if not smarter than us, who are trading the same stock in the opposite direction. So if you're long and there are fundamental-based hedge funds who are short, you need to think about that. So we also have to think about the interest that these players might have. So we spoke about insider ownership, but also the style of the firm that is invested really matters as well. So for example, if a pension fund is invested in your stock, then that might not tell you so much because they have a lot of capital, they have a really long time horizon. So I mean, it doesn't tell you much. So you have to make sure that you don't take any false signals. For example, many index funds also hold large stakes in companies because they have to own them when they create an ETF. So you should not really use something like this to make a directional case. So next thing I wanted to mention is about going short. And we've had a chat with a few of you in our pods. And I think the financials pod is the one who's particularly interested in going short. So remember that if we want to sell something before we buy it, we have to borrow it. And if we're borrowing it from somebody. And because they can actually call their stock back at any time, that could screw you over. So if you want to go short, you have to think about who you're borrowing the stock from. So if a pension fund is long, then happy days, but you don't want to be playing against a hedge fund or an ETF that's trading in and out every month because that can be dangerous for you. So without further ado, I'm going to pass over to Ken, and he's going to take you over some comparable analysis and relative valuation techniques.
Hi, cheers, Sean, for that presentation. Some very interesting ideas there. So, as Benjamin Graham says, aka the father of value investing, an investment operation is one that can be justified on both qualitative and quantitative grounds. And quantitative data can be divided into capitalization, earnings and dividends, and all your financial statement metrics. Whereas your qualitative information are things that we've looked at in our pods, the Porter's 5 forces, and also the quality of management, which Sean discussed earlier. So within our quantitative tools, we've already discussed the DCF, which is an intrinsic model. However, now we're going to look at the extrinsic tool, which is comparable analysis. So what is comparable analysis? Well, imagine you just inherited a house and you want to sell it. The first thing you might do is have a look at the surrounding houses in the area and their prices on the market. Now, there will be some differences in those houses. No two will be exactly alike. There'll be differences in interior design, etc. But looking at this basket of similar properties will give you a reasonable range of values in which your house might sell at. So we can apply this concept with stocks as well. So with an IPO, an investment bank might do a similar thing as part of their valuation to get the IPO price. Or with stocks that are already on the market, they already have a price, which means we can compare their current price to the range of values we identified and see if it's overvalued or undervalued relative to its peers. So this is what we refer to as a football field chart, and we can make this in Excel using our comp table. And here we can see Walmart's current share price is trading in the higher end of its range based on our comparative valuation. So we might want to investigate why it's trading at a premium, or perhaps wait till it gets to the lower end of the range before looking for opportunities. So why do we use comps? Well, partly to fill the other side of the coin. So if we use an intrinsic model such as a DCF, we want to supplement that and add value or validate it with the comparable analysis. And so we can see if the results of the DCF comply with our range that the comparable analysis shows. However, the main reason that we use comps is simply because it's the simplest model, and it's much simpler than M&A models, operating models, and some DCF models. So you can whip up a simple comp table in a matter of minutes, whereas a free statement DCF might take you so long to complete, the company goes bankrupt by the time you finish, which would be a silver lining. So the goal is to get a range of multiples, and then we can extrapolate these to share price values like the football field chart we saw earlier. So how do we do it? Now, if you don't make any money, the letters CVS remind you of the American discount pharmacy. Now, if you do make money, then CVS reminds you of confirm relevant peer universe, validate key fundamental metrics, and select appropriate multiple for valuation. So you have to pick the right multiple. Am I looking at an earnings-based, a sales-based, or an asset-based company? Step 1, and this is to confirm your relevant peer universe. So to do this, you can go to FinViz and go to the screener. So, and then once you go to the screener, you can narrow down and select by industry up here. And then I also recommend that you sort by revenue. Unfortunately, FinViz doesn't have revenue, so you have to filter by market cap, which is a decent proxy. And you can also go onto Seeking Alpha and look at other companies that investors also follow. And as you can see, this list is quite similar to the one we have on FinViz. But you should always double check to see if the business models are actually the same. The next step is to fill out key information. So this is where you get your information, and you also validate your key fundamental metrics. So once you have the shortlist that we saw earlier, you can hop onto Seeking Alpha and go onto financials, and you can, I recommend if you're doing a full model that you get 3 to 5 years of historical data, and then also 2 years of historical prices. Or if you want to do a simpler model, then you don't need to get all the metrics such as EBITDA, where you don't need to get all the other balance sheet metrics, but you do need to get your share price, market cap, EV, sales, EBITDA, EBIT, and earnings up here. So this is a much simpler model, which is only using 1 year of trading earnings. And then step 3. So step 3 is about expanding on step 2 and finding some key industry specific metrics to consider. So in step 2, we talked mainly about the price of earnings and price related multiples, but there are other metrics such as the reserve ratio for oil companies and NAV for miners, which may explain some of our findings from the valuation we get. So one way to get an idea of what to use is by looking at analyst reports, company filings, and company investor presentations to get a sense of what multiple or metric might apply to that industry. So when I wrote an article on gold stocks last year, I watched the McEwen Mining shareholder presentation, and that provided some very useful metrics such as AISC, which is all-in sustaining cost of producing an ounce of gold. And build table, so that refers to filling in this template, which I'll be sharing, and you simply plug in the numbers and it will also calculate the multiples in this range. So finally, you interpret results. And this is where you determine why a company might be trading the way it is. So for example, why is the market trading Dr. Pepper at a significant discount to the Monster Energy, which is trading at a premium? And we could do this by looking at some of the industry specific metrics that we mentioned earlier and try to answer, does Dr. Pepper's earnings really deserve to be priced at half of Monster Energy's earnings? And can we expect a reversion to the mean for Dr. Pepper? So finally, some evaluative points. So one problem about using this kind of style of analysis is that the numerator, which is price, fluctuates daily, whereas the denominator, earnings, is updated only quarterly. So to combat this, you can use a forward P ratio, which swaps the company's projected earnings into the calculation, and instead of its actual recent earnings. And this is why it's best to use a forward estimate, which we mentioned earlier. And finally, it all hinges on step one. So selecting the right peers. Use Seeking Alpha or FinViz and filter by geography, and use market cap if revenues isn't possible. And then we have to compare apples to apples. So EU and US banks, they're not apples to apples because of the completely different policy landscapes and operating conditions for those two banks. So the EU banks have to battle the margin compression of negative rates, whereas the US banks don't. So could I compare US regional banks amongst themselves? Well, yes, but you would have to make sure they follow a similar business model. So you make sure you compare retail banks to retail banks, and again, filter based on size. And that concludes our intro to comp analysis. Thanks for listening.
Yeah, thank you, everyone. So we'll take questions after I just make this one brief point. So we've been speaking to quite a few people about your discounted cash flows. And the point of doing that exercise is not actually to arrive at a specific valuation, since we've made quite a lot of simplifying assumptions, but rather it's to get a better feel for what contributes to the valuation of your business. So when you spend time looking at the margins and understanding the nature of the cost they incur, the nature of how they're taxed, how they're financed, and look at them compared to other similar businesses, you can get a good feel for the things that you should really be keeping your eye on, and what are the drivers that the market is really acknowledging as well. So yeah, on that note, we'd like to wrap it up. If there's any questions you have, feel free to ask us now, or we can answer them in our breakouts during this week.